In today's headline, Aquarian raises nearly $1.5 billion from the sovereign wealth fund Mubadala, based in Abu Dhabi. And Aquarian was launched around 2017 by ex-Guggenheim Partners executive Rudy Sahay. He joins me now. And it's interesting because, of course, we know that when you look at a lot of the money being raised for these types of strategies, it is coming from the Middle East. Mubadala is pretty selective when they look at these strategies. Why is insurance and credit right now kind of such a hot ticket? Not just, frankly, from Mubadala and you, many other people. We reported last week that your former boss, Todd Boehly, is doing a very similar thing.
Yeah. Well, first of all, Sonali, thanks for having me on. I really appreciate the opportunity. Let me just give people a quick overview of what we're doing at Aquarian, and then I can answer your question. So the way Aquarian is set up is we're a diversified global holding company. We have an insurance arm that has a strategic portfolio of 5 insurance companies that we own and operate. Sitting next to them as a sister company is an asset manager that manages all of the money for those insurance companies with an orientation towards the liabilities first. I can't speak to what the market is doing or what individual companies are doing, but the opportunity that we see is in the US, we hit peak 65 in 2024, which is the baby boomers are retiring at the fastest clip we've ever seen, and they're looking for retirement income solutions, and that's fundamentally the product that we're offering to the market.
Now, it's worth talking a little bit about the credit part, the asset management part of your business, because one thing you've told me before is you might use some of this money to go out, potentially seek acquisitions, expand those credit platforms at a time where credit is seeming to make this massive comeback. And so what types of credit are you looking at more specifically that is showing the most misplaced opportunity in the market?
So fundamentally, the market is limited from a liquidity perspective. And what we have right now is actually quite a bit of liquidity within our segment. And so we're looking at opportunities in real estate, private credit, and general corporate credit as well. The markets about a year ago thought that we were going to be in a higher for shorter period, and we're obviously higher for longer now. And so the way that people had liquidity planned is not what's actually happening today. So we're seeing fantastic opportunities to get paid a phenomenal risk premium relative to what the market thought about a year ago.
Where is that risk premium? Because on one hand, you've seen gobs of money float into private credit, but you are looking both at those liquid credit opportunities and private credit. Is one better than the other right now?
It just depends on the specific company and who's coming to market. It's a credit by credit analysis. It's a credit picker's market at this point. We can't make a blanket industry statement because there are great companies in the private credit market and great companies in the public credit market. You just have to find the diamond in the rough, so to speak.
It's not for the faint of heart here. These are riskier markets sometimes, high yield markets in particular. Yep. How do you think about risk right now as you see signs of weakening in the economy?
So nothing in finance is for the faint of heart, to be completely honest with you. It's a bare knuckle brawl every single day. The way that we're seeing risk is a fundamental mispricing of what people will do outside of your control.
So where's that mispricing?
You see it where people think interest rates will go down sooner than they believed before. The way we look at our risk and the way we manage our portfolio is we're thinking about the individual business and whether that business has the capability to stand for the long term. Our capital has a long-term duration and orientation, and we're looking for the right partners who can execute on that vision.
We only have about a minute left here, but where do you see people maybe flying into risk that they shouldn't be? Asked differently, what are you avoiding?
We start fundamentally, and we look at every single business, every opportunity from the ground up. We don't look at ratings as an indication. We don't look at sectors as an indication because, as you and I both know, stereotypes or broad generalizations often turn out to lead you down a fool's path. What we look at is individual credit, individual opportunities, and we find those unique moments where we can exercise our capital and put it to work in the most powerful way.
Now, that's all well and fine, but how do you know at the end of the day that that analysis is good enough, especially when you're avoiding ratings? Do you not trust the ratings anymore? Is there a problem with how widely they're able to
We trust the ratings implicitly, the way that they're set up. We always have to trust but verify, and that's what a good investor does at all points. And so we make sure we have our own credit orientation first and then follow up on the back end.